Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video we're going to discuss the philosophy of the Blue Collar Investor system. One of my concerns has been the fact that so many average retail investors, such as ourselves, have always felt that we're not capable of investing with stocks. I think the reason has to do with the fact that we were never taught how to do this in school. So it's become ingrained in our society that we must go to a professional to take care of our hard-earned money. Now, I'm not saying that there's anything wrong with going to a good professional, but what I am saying is that we are definitely capable of doing this ourselves. So let's take a look at a basic example of what a covered call right is, and then we'll get more into the philosophical aspects of my system. And let's take, for an example, we purchase a stock of the Blue Collar Investor Corporation, 100 shares because that's equal to one options contract, at $48 a share. So our investment is $4,800. Now we turn around and we sell the option. We sell the right but not the obligation to some unknown person, because it's all done online, to purchase those shares from us for $50 in this example, at any time over the next 1 month. In return, we'll receive a premium. Now, an average premium for something like this would be about $1.50. For the 100 shares, $150. Now, if we divide that by our cost basis of $4,800, that gives us a 3.1% 1 month return. Now, at the end of the month, if we sell the stock for $50, which means that the market price did go past the agreed upon $50 sales price, which is also called the strike price, then we've made another $200 on the sale of the stock. So our total profit would be the $150 from the sale of the option, plus the $200 from the sale of the stock, for a total of $350. And if you divide that by our cost basis of $4,800, that'll give us a whopping 7.3% 1 month return. Now, can we lose money when we sell options? The answer is yes, we can. But the risk is in the stock, not in the option. So if that stock drops in value by more than the price that we sold the option for, the $150, then we could start losing money. So as you could see from this basic example, a very critical part of writing covered calls is to select a stock that is less likely to go down in value to protect that option profit. So let's say, what is the formula for success? Let's talk about that. Well, what are the institutional investors? What type of stocks do they like? Because those are the ones that really support our stocks. The hedge funds, the mutual funds, the banks, the insurance companies. They control the market, not you and me. So we'll select stocks that they like, the ones least likely to go down. And those are the ones that are fundamentally sound in terms of earnings and revenues. And in my system, I will show you how to do this. Then we also use technical analysis, so we look at the price charts to determine our buy-sell decisions. So a very, very big part of my system is to learn how to utilize technical analysis. And it's really not that difficult. Now we throw in some common sense guidelines, like, for example, never sell an option when a stock has an upcoming earnings report. Also, we should be properly diversified. Don't put too much money into one stock or into one particular industry. That's just common sense. And selecting the best strike price, very important. Not many people think about this, but in the previous example, we sold the $50 strike price. There may be times when it makes more sense to sell the $45 strike price. And in my system, I'll show you how to make these determinations. Next, if the stock does go down, we don't want to sit there like a deer in headlights and feel sorry for ourselves. We want to act, and we act by using exit strategies. We can always get out of our position by simply buying back the option. And then we can act in one of several ways, and that's a very, very big part of my system as well. So All of our decisions need to be non-emotional, based on sound, fundamental, and technical principles, and we sprinkle in a whole lot of common sense. And finally, we take these cash profits and we compound them. We send our money out to work for us. So let me give you a couple of examples of two of the things that I mentioned. We'll talk about technical analysis first. And in the very brief time period that we have here, I'm just going to show you a price chart, two price charts actually side by side. And the one on your left as you're looking at the screen is a stock that's heading off to the moon, as you could see by the arrow pointing up. That means the price has upward price momentum. It's being supported by the institutional investors. And on your right, as you're facing the screen, we see another stock that's crashing to the ground. And you could see the red arrow heading down. So if we looked at a chart pattern of the one on the left, we would be excited about having that stock in our portfolio. And if we looked at the chart pattern on the right, we would say to ourselves that we don't want to get involved with this stock, at least not until the price pattern starts to turn around. Let's talk about compounding for a moment, and specifically the rule of 72, which many of you probably know already. But for those who don't, what the rule of 72 states is that if you take the annual return of your investment and divide it into the number 72, that will tell you how many years it will take to double your money. So for example, if you invested in a 6% CD, which you really can't anymore, if you had $100,000, that would double to $200,000 in 12 years, because 6 into 72 is 12. Now, if we're selling stock options and we're gaining 2 to 4% a month, which in an average market is something we should all be doing, let's take a look and see how the rule of 72 applies. And what I'm going to do is I'm going to use the most conservative 2% a month. That comes to 24% a year. So if we divided 24 into 72, we would double our money every 3 years. So now if we took the same 12-year time frame as with the 6% CD and the same $100,000 starting point, if we sold options with a 2% a month return, that $100,000 would then become $1.6 million instead of the $200,000 that the 6% CD gave us. So you could see that by hitting a lot of singles and doubles and getting those small returns and compounding them, it could add to our financial future. So to summarize, this is what the philosophy of the blue-collar investor system is. We blue-collar investors only select the greatest performing stocks in the greatest performing industries. And then we use technical analysis to determine our buy-sell decisions. We sell the most sensible options. We look at which strike price makes the most sense for this given market environment and for the technical pattern of that particular stock. This is not rocket science, folks. We manage our positions through exit strategies. And I've written an entire book on this one subject. And then, of course, we take our profits and we reinvest them so that we can compound our money. And finally, blue-collar investors have one thing in common. We're all on a path to financial freedom. So I hope you enjoyed this video. I look forward to hearing from you in the future, and I want you to know that I appreciate the fact that you took the time to visit my website. Take care, everybody.